What's going on, everybody? TG here, back with another video. Guys, before we start this video, hit that subscribe button, hit that like button. It does a ton for me and my channel. It helps us grow, and I really do appreciate it. But let's go on and jump into this video. This is all about the FAANG stocks and why I am selling bullish put credit spreads on these FAANG stocks and why I think you should take advantage of this as well. Now, look, I'm not a financial advisor, and all these trades have risk, yada, yada, the whole spiel that we got to give, but let's just jump right into this, guys. It's mainly on Amazon, Apple, and Microsoft right now. I do want to get one on Google, but I'm waiting for Google to have a slight more of a dip because Google has had a phenomenal run-up these past 3 months because of amazing earnings that they had. But let's first start off with Amazon. My baby, my favorite stock in the world, Amazon. It hasn't been doing too well. It has not been doing too well at all. We go ahead and look at this 3-month. Just not doing well at all. Just kind of been sitting in that weird channel. Got as high as, this, and dropped down. It's just not doing too good. So what are we doing? All right. Well, here's the thing. We can buy calls upright. We already have our shares. Obviously, we have $100,000 worth of Amazon shares. Obviously, a lot of margin. 101,000 actually. We're down 0.5%. Not worried about that at all. But it's really been underperforming. So what do? We sell these things called put credit spreads on it. We have one here for January 8th. Saying that Amazon will not be under 2,900 by January 8th. Right now, it's even, down like 6% on it. And it's a pretty safe bet if you think about it. Amazon to go under 2,900 would have to have a huge, huge drop. Okay, and we don't think that's going to happen. So we risk a decent amount of money to make about 25% return on investment. Risk like $2,000 to make about $400. So that's one of them. We also have the other one, which is a 2,800 one, where we're risking $2,000 to win, again, $420. A lot more safe, though, because it's 2,800. So the odds of it going down there are extremely slim. We're already up 33% on that. Now, we did another one today. This one is a little more risky. We put up $5,000, and we collected about $2,100 in premium. That's about 42% return on investment right there. And it's saying that Amazon will stay above $28.50 by next July. Now, Amazon hasn't done anything in 5 months. In 5 months, the stock is down 100 points in 5 months. Okay? Now, as someone who sees a quarter like Amazon has had, where it is bringing in $96 billion last quarter, $89 billion this quarter, or the quarter before that, and expecting to do $120 billion. If it hits 3 consecutive back-to-back earnings beats, there is no way this stock is staying stationary. It is going to fly. But I'm trying to hedge myself a little bit. Okay, let's say Amazon does not fly. I am saying that it's not going to drop all the way to $28.50 despite having these amazing earnings. I think it's a pretty safe bet. Obviously, there's some risk involved in case the market crashes and Amazon gets dragged down with it. But as we've seen, pandemics actually help Amazon and the stock flies because of it. So we're putting a pretty significant bet on it, as you guys can clearly see. We're risking $5,000, making $2,100. And, we're basically saying Amazon's going to stay above $28.50 in about 6 months from now. It's a pretty safe bet. 7 months from now, actually. It's a pretty safe bet, but obviously they do have some risks. Now, we also have some options on Apple. This Apple option is a long-term leaps put. We had 2 of these initially. We locked in one for profit, and we're holding this next one to get an extra $500 out of it. Essentially saying that Apple is not going to go under 112.5 by March 19th. And if it does, we pick up 100 shares. So this is the least risky one because worst case scenario, we pick up 100 shares of the company. The other ones, if it goes under, we just lose that amount of money. So this is obviously a lot more safe, but it also, you have to put up a lot more money. I have to put up over $11,500 to be able to sell this cash secured put. So a little bit more risky, but Apple's amazing. I mean, we look at Apple's earnings and stuff as well. Just incredible. Absolutely incredible. $64 billion in revenue, $12.6 billion in profit. And I think next quarter between their iPhone 12 and the wearables continuing to increase, especially the iPhone 12, it's just going to be another killer quarter, especially with their App Store. It's just completely dominating. Now, another one that we have is Microsoft. People don't like to talk about Microsoft, but Microsoft is an amazing company. Microsoft is in a lot, and especially as its foot up in advertising, it has its foot up in cloud storage data, which is also what Amazon does with AWS, and they've been killing it with that. Remember, they're also the owner of Xbox. Not a lot of people know that, but these console sales this quarter is going to be on that report, so I think it should do pretty well. And not to mention, just Microsoft's just a solid company around, has great technology behind it, and again, has not done much at all in the past couple months. We look at it where it was in July of last year, like July 10th, 213. It's literally 40 cents away from where it was. In this entire time, the stock has went down 41 cents from where it was. So, it's primed and ready. It's had good earnings to back it up. I mean, if we look at this is just incredible. $13.9 billion in profit, up 30% year over year. Just incredible growth right there. And that's why we went ahead and sold a lot of Microsoft put credit spreads. 195 February 19th. Microsoft, in my opinion, is not going under 195. I don't even think it's going under 210, to be honest with you. Maybe 205. But we're being safe. We got $557 and we're risking $2,500. Like I said, about another 25% return on investment. This is a very safe strategy unless there is a huge market crash. Sorry, man, my throat's killing me. We're using Theta to our advantage. We're using Vega to our advantage. We're taking advantage of these high probability outcomes for us. They're low probability outcomes for the people buying it. They're high probability for us. We are essentially playing the house in a casino. It's TG's casino. Anyone's welcome to come in and take a gamble and see what happens. But there's a good old quote: "The house always wins," and hopefully the house will win because we are the house for these options. So we're betting safe. We're betting on big tech. Big tech has been slept on. People are sleeping on big tech, and I'm not sure why, to be honest with you. Despite posting amazing earnings, people don't like their PE ratios on some of these companies, like Amazon, who sits at a 91 PE ratio. But I mean, there's a lot of companies that have PE ratios much, much, much higher with much less growth potential. Airbnb, a couple of these other ones. Actually, Airbnb can't even have a PE ratio because it's not profitable because it loses $1 billion a year. But that's a separate video. We already made that yesterday. But guys, we're trying to stay positive on these tech companies. Also, Home Depot is another one that we're in. We have some put credit spreads on it. A lot of put credit spreads on Home Depot. And then Jumia as well. We like Jumia, the future of it. It's actually doing very, very well. But essentially, guys, that's it. We're just betting on big tech. And this is a safe strategy that basically says, even if big tech goes down a little bit these next couple months or stays the same or goes up, we make money. We collect all the premium for it. So with that being said, guys, let me know your thoughts on this strategy. Let me know if you are into these put credit spreads and your thoughts on big tech stocks like Amazon, Apple, Microsoft. But that's essentially about it, guys. Hit that subscribe button. Let me know how you guys like this video, and I'll talk to you in the next one. Have a wonderful weekend, guys. Bye.